Welcome to Cotality's Housing Market Update for April 2026. Brought to you by onthehouse.com.au. First, the national picture. Cotality's National Home Value Index rose by 0.7% in March, taking values 2.1% higher over the March quarter. Values are still rising, but the growth rate is easing, down from a 2.8% lift in the December quarter last year. The housing market performance is becoming increasingly uneven by city and by price point. In Sydney and Melbourne, we're seeing the early stages of a downturn. Since November 2025, Melbourne housing values are down by 0.9% and Sydney's down 0.4%. At the same time, auction clearance rates have been falling and advertised supply levels are lifting, providing buyers with more choice, less urgency, and vendors are facing more negotiation. Now contrast that with Perth, where momentum is running the other way. Housing values are up 2.5% in March and they were 7.3% higher over the quarter. In dollar terms, that quarterly lift adds about $69,000 to the median dwelling value. Clearly, this pace of growth isn't sustainable long-term, but it's being underpinned by the fundamental constraint of low supply, with advertised stock levels sitting about 40% below the 5-year average for this time of the year. We're also seeing a split across the value tiers. In most capitals, the lower quartile, or the most affordable end of the market, has been leading the growth. Sydney is the clearest example. Over the March quarter, upper quartile values fell by 1.8%, while the lower quartile of the market was up 1.8%. The driver here is increased competition for lower-priced housing stock. Serviceability constraints are deflecting more demand towards the lower end, alongside a lift in first home buyer activity supported by stimulus and elevated investor participation. Regionally, housing markets are showing more resilience. Values rose 1.1% over March and 3.3% over the quarter, compared with a 0.6% and 1.8% rise across the combined capitals. Again, it's regional Western Australia that stands out, up 2.2% in March and 6.2% higher over the quarter. Bunbury is leading the pace, with values jumping 8.4% over the quarter to be 22.2% higher over the past 12 months. There's also early signs that demand is cooling. Cotality estimates the quarterly home sales are tracking 1.9% lower than a year ago and 5.6% below the 5-year average. With cost of living pressures and interest rate uncertainty still in play, along with confidence impacted by geopolitical risk, it's reasonable to expect that purchasing demand is going to remain softer in the near term. Let's turn to rentals. The monthly trend in national rental growth has held around 0.7% over the past 3 months, taking the quarterly change to 2.1%, the largest 3-month lift since May 2024. Annually, rents are up 5.7%, adding about $37 a week to the median rental rate. Vacancy rates remain tight. Nationally, the rental vacancy rate edged up to 1.6% in March, still well below the decade average of 2.5%. Every capital city is showing a vacancy rate below 2%, with Adelaide the tightest at 0.9%, Perth at 1.1%, and Sydney the highest at 1.7%. The challenge is that this reacceleration is happening when rental affordability is already stretched. A household on the median income, renting at the median rental rate, is dedicating about 33% of their pre-tax income to paying rent. And from a macro perspective, stronger market rents are a problem for inflation. Rents have a very large weighting in the CPI, and CPI rental inflation typically follows market rents with a lag. The pace of growth in Perth housing values accelerated in March, with the market up 2.5% over the month, taking the quarterly gain to 7.3%. The past 12 months has seen Perth housing values rise by 24.3%, adding the equivalent of about $200,000 to the median home value. Growth conditions remain strongest across the more affordable price points, with lower quartile values surging 9.2% through the March quarter, while upper quartile values are up 5.8%. Low advertised stock levels remain a feature of the market. Although listing numbers are rising, total stock levels remain about 40% below average for this time of the year. So how's the housing market shaping up for 2026? The market's facing a worsening mix of cyclical and external headwinds, including record levels of affordability, serviceability constraints, rising cost of living expenses, and weakening sentiment. All of these factors were apparent before the Iran war, which is set to amplify some of these factors. On affordability, dwelling values relative to household incomes are at record levels, and higher mortgage rates are increasingly weighing on borrower serviceability assessments. Factoring in a 3 percentage point serviceability buffer, most borrowers effectively need to show they can service a new loan with a mortgage rate around 9%. This combination of affordability and serviceability constraints is shrinking the pool of buyers who can comfortably transact, with the impact most visible across the higher price points of the market. This situation is set to become more pronounced if interest rates move higher, as most economists are expecting. Confidence has deteriorated through the month as cost of living pressures and geopolitical uncertainty have intensified. Historically, housing activity has followed trends in consumer sentiment, with lower confidence accompanied by fewer home sales. Softer selling conditions can already be seen in auction clearance rates, which have eased to below average levels, while advertised stock levels have been lifting, particularly in Sydney and Melbourne, implying less urgency for buyers and a gradual shift towards more balanced conditions. On the flip side, supply remains tight in aggregate, which should help limit the risk of a sharp correction in prices. That said, there are early signs of some easing at the margins. New listing numbers have picked up, and construction activity has improved modestly in a number of states. A sustained supply recovery still looks difficult. Construction costs remain elevated and are probably set to face renewed upwards pressures via higher fuel prices and material costs, which will weigh further on the feasibility of new housing projects. The labour market remains a key stabiliser. Employment is still high and conditions are tight, which supports income security and reduces the risk of forced selling, even as real incomes are squeezed and sentiment is weaker. Also, policy support is still present for first home buyers. The deposit guarantee scheme can help first home buyers clear the upfront deposit hurdle in lower price segments of the market. However, strong price growth at the lower value range, together with higher interest rates and living costs, means that stimulus is likely to have a diminishing impact from here. Overall, early 2026 conditions are shaping up to be more cautious and more sensitive to debt servicing and cost of living shocks. With inflation and interest rate uncertainty still front of mind, confidence is weaker and the near-term balance of risks is tilted to the downside. Tight supply and labour market resilience should provide some support for housing prices, but the scope of broad-based price gains looks limited. We expect outcomes to remain uneven through 2026. More affordable segments may hold up better as demand concentrates where serviceability still works, while higher value market segments are still facing larger headwinds from borrowing constraints and cost pressures. The key watch points from here are going to be the path of inflation and interest rates, the extent of any further lift in listings, and whether confidence stabilizes. With the market evolving rapidly, it's more important than ever to stay up to date with all the twists and turns. You can stay tuned to all the housing trends at the insights pages of the Cotality website.